Okay, now I'm going into Truth in Lending Act. I'm finishing it up in subsection E at this point, 1026.35, requirements for higher price mortgage loans. And the first section is definitions. For purposes of this section, higher price mortgage loan means a closed-end consumer credit transaction secured by the consumer's principal dwelling with an annual percentage rate that exceeds the average prime offer rate for a comparable transaction as of the date interest rate is set by 1.5 or more mortgage points or loans secured by a first lien with a principal obligation at consummation that does not exceed the limit in effect as of the date the transaction's interest rate is set for the maximum principal obligation eligible for purchase by Freddie Mac, or it exceeds APOR by 2.5 or more percentage points for loans secured by a first lien with a principal obligation at consummation that exceeds the limit in effect as of the date the transaction interest rate is set for the maximum principal obligation eligible for purchase by Freddie Mac, or by 3.5 or more percentage points for loans secured by a subordinate lien. So just to clarify, the sections prior to this where we talked about high cost mortgages and reverse mortgages, and now we're discussing higher priced mortgage loans. The HPML is different than the HCM, high cost mortgage loans. Clearly here it's triggered by different interest rates, and it has different requirements. High cost mortgage loans, however, are also considered HOEPA loans, or at least the interest thresholds are the same for triggering a high cost mortgage loan and a HOEPA loan, just for further information. Number 2 under the definition section is APOR, which means the annual percentage rate that is derived from average interest rates, points, and other loan pricing terms currently offered to consumers by a representative sample of creditors for mortgage transactions that have low-risk pricing characteristics. The Bureau publishes average prime offer rates for a broad range of types of transactions in a table updated at least weekly, as well as the methodology the Bureau uses to derive these rates. So the Bureau now releases APOR, but in my experience, I've seen it done through the FFIEC or Freddie Mac. Escrow accounts defined is 1. The requirement to escrow for property taxes and insurance, except as provided in paragraph B2 of this section. A creditor may not extend a high-priced mortgage loan secured by a first lien on a consumer's principal dwelling unless an escrow account is established before consummation for payment of property taxes and premiums for mortgage-related insurance required by the creditor, such as insurance against loss or damage to the property, or against liability arising out of the ownership or use of the property, or insurance protecting the creditor against the consumer's default or other credit loss. For purposes of Section B, the term escrow account has the same meaning as under RESPA as amended. Exemptions. Number 2, notwithstanding paragraph B1 of the section, an escrow account need not be established for a transaction secured by shares in a cooperative, a transaction to finance the initial construction of a dwelling, a temporary or bridge loan with a loan term of 12 months or less, such as a loan to purchase a dwelling where the consumer plans to sell a current dwelling within 12 months, or a reverse mortgage subject to 1026.33. That's probably a bit better. Okay. 10.33, I said. Insurance premiums described in paragraph B1 of this section need not be included in escrow accounts for loans secured by dwellings and condominiums, planned unit developments, or other common interest communities in which dwelling ownership requires participation in a government association where the governing association has an obligation to the dwelling owners to maintain a master policy ensuring all dwellings. Except as provided in paragraph B2.5 of this section, an escrow account need not be established for a transaction if at the time of consummation A, B, or C, D, or D, A, during any of the 3 preceding calendar years, the creditor extended more than 50% of its total covered transactions as defined in 1026.43. B1 secured by a first lien on properties that are located in countries, that are either rural or underserved, as set forth in paragraphs B to 4 of this section. B, during the preceding calendar year, the creditor and its affiliates together originated 500 or fewer covered transactions as defined by 1026.43B1, secured by a first lien, and C, as of the end of the preceding calendar year, the creditor had total assets of less than $2 million. And this asset threshold shall adjust automatically each year based on the year-to-year change in the average of the CPI for urban wage earners and clerical workers, not seasonally adjusted for each 12-month period ending in November, with rounding to the nearest $1 million. See comment 35B23I.3 for the current threshold, and do what? Alright, threshold. And neither the creditor nor the affiliate maintains an escrow account, the type described in paragraph B1 of the section, for any extension of consumer credit secured by real property or a dwelling that the creditor or its affiliate currently services, other than 1 and 2. 1. Escrow accounts established for first lien higher price mortgage loans on or after April 1st, 2010 and before January 1 of 2014, or 2. Escrow accounts established after consummation as an accommodation to distressed consumers to assist such consumers in avoiding default or foreclosure. Roman numeral 4 is the definition of rural. During the calendar year, a county is considered rural if it is neither in a metropolitan statistical area nor in a micropolitan statistical area that is adjacent to a metropolitan statistical area, as those terms are defined by the U.S. Office of Management and Budget and as they are applied under currently applicable urban influence codes established by the United States Department of Agricultural Economic Research Services. It's USDA-ERS. A creditor may rely as a safe harbor on the list of counties published by the Bureau to determine whether a county qualifies as rural for a particular calendar year. B, a county is underserved during a calendar year if, according to HMDA data, the preceding calendar year, no more than 2 creditors extended covered transactions as defined in 1026.43B1, secured by a first lien 5 or more times in the county. A creditor may rely as a safe harbor on the list of counties published by the Bureau to determine whether a county qualifies as underserved for a particular calendar year. Roman numeral 5, notwithstanding paragraph B2, Roman numeral 3 of this section, an escrow account must be established pursuant to paragraphs B1 of the section for any first lien higher priced mortgage loan transaction. And God, Erica. That at consummation is subject to the commitment to be acquired by a person that does not satisfy the conditions in paragraph B2(3) of this section unless otherwise exempted by this paragraph B2. Cancellation, Roman numeral 1, general, except as provided in paragraph B3, Roman numeral 2 of this section, a creditor or servicer may cancel an escrow account required by paragraph B1 of this section only upon the earlier of A, the termination of the underlying debt obligation, or B, receipt no earlier than 5 years after consummation of a consumer's request to cancel the escrow account. Roman numeral 2, delayed cancellation. Notwithstanding paragraph B3(1) of this section, a creditor or servicer shall not cancel an escrow account pursuant to a consumer's request described in paragraph B3, Roman numeral 1B of this section, unless the following conditions are satisfied. A, an unpaid principal balance is less than 80% of the original value of the property securing the underlying debt obligation, and B, the consumer currently is not delinquent or in default on the underlying debt obligation. C. Appraisals. Definitions. For the purpose of this section, a certified or licensed appraiser means a person who is certified or licensed by a state agency in the state in which the property that secures a transaction is located, or who performs the appraisal in conformity with the uniform standards of professional appraisal practice and the requirements applicable to appraisers in Title 11 of FERA of 1989 as amended, and any implementing regulations in effect at the time the appraiser signs the appraiser certification. 2. Credit risk means the financial risk that a consumer will default on a loan. Manufactured home has the same meaning as Title 24 of the Code of Federal Regulations, Section 3280.2. Don't know who that belongs to. Probably FHA or something. Or FIFA. Manufacturer's invoice means HUD. Manufacturer's invoice means a document issued by a manufacturer and provided with a manufacturer home to a retail dealer that separately details the wholesale base prices at the factory for specific models or series of manufactured homes and itemized options, large appliances, built-in items and equipment, plus actual itemized charges for freight from factory to the dealer's lot or the home site, including the rental of wheels and axles, and for any sales taxes to be paid by the dealer. The invoice may recite such prices and charges on the itemized basis or by stating an aggregate price or charge as appropriate for each category. Roman numeral 5, National Registry means the database of information about state certified and licensed appraisers maintained by the Appraiser Subcommittee of the Federal Financial Institutions Examination Council. Roman numeral 6, that's the FFIEC. Roman numeral 6, new manufactured home means a manufactured home that has not been previously occupied. Roman numeral 7, state agency means a state appraiser, certifying and licensing agency recognized in accordance with sections 1118 of the FERA and any implementing regulations. 2. Exemptions unless otherwise specified. The requirements under paragraph C3 through 6 of the section do not apply to the following types of transactions. You have Roman numeral 1, a loan that satisfies the criteria of a qualified mortgage. 2, an extension of credit for which the amount of credit extended is equal to or less than the applicable threshold amount, which is adjusted every year to reflect increases in the CPI as applicable and published in the official staff commentary to this paragraph. Roman numeral 3, a transaction secured by a mobile home, boat, or trailer. Roman numeral 4, a transaction to finance the initial construction of a dwelling. 5, a loan with a maturity of 12 months or less if the purpose of the loan is a bridge loan connected with the acquisition of a dwelling intended to become the consumer's principal dwelling. Roman numeral 6, the reverse mortgage transaction subject to Section 33, I just went over. Roman numeral 7, an extension of credit that is a refinancing secured by a first lien with refinancing defined as in 1026.20a, except that the creditor need not be the original creditor or holder or servicer of the original obligation, provided that refinancing meets the following criteria. Either one, the credit risk of the refinancing is retained by the person that held the credit risk of the existing obligation and there is no commitment at consummation to transfer the credit risk to another person, or 2, the refinancing is insured or guaranteed by the same federal government agency that insured the guaranteed or existing obligation, and B, the regular periodic payments under the refinance do not, 1 through 3, cause the principal balance to increase, 2, allow the consumer to defer repayment of principal, or 3, result in a balloon payment as defined under 1026.18 S5I, and 3, provided that the financing meets the following criteria. C, that is, the proceeds from the refinancing are used solely to satisfy the existing obligation and amounts attributed solely to the costs of the refinancing. In Roman numeral 8 now, a transaction secured by a new manufactured home and land, but the exemption shall only apply to the requirement in paragraph C3.1 of this section that the appraiser conduct a physical visit of the interior of the new manufactured home, or B, a manufactured home and not land for which the creditor obtains one of the following and provides a copy to the consumer no later than 3 business days prior to the consummation of the transaction. 1, for a new manufactured home, a manufacturer's invoice for the manufactured home securing the transaction, provided that the date of manufacture is no later than 18 months prior to creditor's receipt of the consumer's application for credit. 2, a cost estimate of the value of the manufactured home securing the transaction obtained from an independent cost service provider. Or 3, a valuation as defined in 1026.42b3 of the manufactured home performed by a person who has no direct or indirect interest, financial or otherwise, in the property or transaction for which the valuation is performed and has training in valuing manufactured homes. 3, appraisals required. 1, in general, except as provided in paragraph C2 of this section, a creditor shall not extend a higher price mortgage loan to a consumer without obtaining prior to consummation a written appraisal of the property to be mortgaged. The appraisal must be performed by a certified or licensed appraiser who conducts a physical visit of the interior of the property that will secure the transaction. Roman numeral 2, safe harbor. A creditor, and this is under appraisals required, a creditor obtains a written appraisal that meets the requirements for an appraisal required under paragraph C3, Roman numeral 1 of the section, if the creditor A, orders the appraiser perform an appraisal in conformity with U.S. PAP, right? Uniform Standards of Professional Appraisal Practice, and Title 11 of FIRA as amended, and any implementing regulations in effect at the time the appraiser signs the appraiser's certification. And B, verifies through the National Registry that the appraiser who signed the appraiser's certification or who was certified or licensed appraiser in the state in which the appraised property is located as of the date the appraiser signed the appraiser's certification. C, confirms that the elements set forth in Appendix N to this section are addressed in the written appraisal, and D, has no actual knowledge contrary to the facts or certifications contained in the written appraisal. 4, additional appraisal for certain higher price mortgage loans. In general is Roman numeral 1, except as provided in paragraph C2 and C4, Roman numeral 7 of this section, a creditor shall not extend a higher price mortgage loan to a consumer to finance the acquisition of a consumer's principal dwelling without obtaining prior to the consummation 2 written appraisals if the seller acquired the property 90 or fewer days prior to the date of the consumer's agreement to acquire the property, and the price in the consumer's agreement to acquire the property exceeds the seller's acquisition price by more than 10%, or the seller acquired the property 91 to 180 days prior to the date of the consumer's agreement to acquire the property, and the price in the consumer's agreement to acquire the property exceeds the seller's acquisition price by more than 20%. Roman numeral 2 under 4, which is the additional appraisal for certain HPMLs, different certified or licensed appraisers. The 2 appraisers required under paragraph C4, 1 of the section may not be performed by the same certified or licensed appraiser. Roman numeral 3, relationship to the general appraiser requirements. If 2 appraisals must be obtained under paragraph C4, Roman numeral 1 of the section, each appraisal must meet the requirements of paragraph C3, 1 of this section. Roman numeral 4, required analysis in the additional appraisal. 1 of the 2 required appraisals must include analysis of the difference between the price at which the seller acquired the property and the price that the consumer is obligated to pay to acquire the property as specified in the consumer's agreement to acquire the property from the seller. And B, changes in market conditions between the date the seller acquired the property and the date the consumer's agreement to acquire the property. And C, any improvements made to the property between the date the seller acquired the property and the date of the consumer's agreement to acquire the property. Roman numeral 5, no charge for the additional appraisal. If the creditor must obtain 2 appraisals under paragraph C4, 1 of this section, the creditor may charge the consumer for only 1 of the appraisals. Roman numeral 6, creditor's determination of the prior sale and date. Reasonable diligence. A creditor must obtain 2 written appraisals under paragraph C4, 1 of this section unless the creditor can demonstrate by exercising reasonable diligence that the requirement to obtain 2 appraisals does not apply. The creditor acts with reasonable diligence if the creditor bases his determination on information contained in the written source documents, such as documents listed in Appendix O to this part. B, inability to determine prior sale date or price. The things under Appendix O to this part might like explain that the first sale was a foreclosure, or that the second, that the first sale, between the first sale and the second sale, there was like considerable amounts of construction or renovation work being performed to the property. And if that be the case, then and reasonable diligence of the inspection of official documents can be documented or shown, then a requirement to do a second appraisal can be waived under these circumstances. B, the inability to determine prior sale date or notice modified requirements for additional appraisal. If, after exercising reasonable diligence, a creditor cannot determine whether the conditions in paragraphs already stated under C4 are present, and therefore must obtain 2 written appraisals in accordance with those paragraphs of the section, one of the 2 appraisals shall include an analysis of the factors in those paragraphs of this section only to the extent that the information necessary for the appraisal to perform the analysis can be determined. 7. Exemptions from the additional appraisal requirement. Let me just think about this for a second. What they're saying is, if you don't know when the house was last transferred before the transaction that the borrower is currently requesting, then you're going to need another appraisal to determine when it was last conveyed and at what price in order to even determine if a second appraisal needs to be done. That's kind of the gist that I'm getting from this. Which I would think due diligence should be able to apply here, but I think what they're saying is that if you don't know, then do another appraisal. Even if it's just for those to determine those 2 items, the last conveyancing date and the price. If there's an inability to determine the prior sale date or price, modified requirements for additional appraisal apply. Did I read Roman numeral 7, exemptions from the additional appraisal requirement? The additional appraisal required under that paragraph of this section shall not apply to extensions of credit that finance a consumer's acquisition of property from a local, state, or federal government agency, from a person who acquired title of the property through foreclosure, deed in lieu of foreclosure, or other similar judicial or non-judicial procedure as a result of the person's exercise of rights as the holder of a default of mortgage loan, from a nonprofit entity as part of the local, state, or federal government program under which the nonprofit entity is permitted to acquire title to single-family properties for resale from the seller who acquired title to the property through the process of foreclosure, deed in lieu of foreclosure, or other similar judicial or non-judicial procedure, from a person who acquired title of property by inheritance or pursuant to court order of dissolution of marriage, civil union, or domestic partnership, or a partition of joint or marital assets to which the seller was a party, from an employer or relocation agency in connection with the relocation of an employee. F, from a service member as defined who receives a deployment or permanent change of station order after the service member purchased the property, or located in an area designated by the President as a federal disaster area, if and for as long as the federal financial institution regulatory agencies as defined waive the requirement in Title 11 of FIRA as amended and any implementing regulations in that area, or H, located in a rural county as defined. Required disclosures, number 5, in general, which I'm guessing number 5 under appraisals. In general, except as provided in paragraph C2 of this section, a creditor shall disclose the following statement in writing to a consumer who applies for a higher price mortgage loan. We may order an appraisal to determine the property's value and charge you for this appraisal. We will give you a copy of any appraisal, even if your loan does not close. You may pay for an additional appraisal for your own use at your own cost. Compliance with the disclosure requirement in Reg B satisfies the requirements of this paragraph. And that's Reg B, section 1002.14a2. Timing of disclosure. The disclosure requirement paragraph C5(1) of the section shall be delivered or placed in the mail no later than the 3rd business day after the creditor receives the consumer's application for a higher price mortgage loan subject to paragraph C of the section. In the case of a loan that is not higher price mortgage loan subject to paragraph C of this section at the time of application but becomes a higher price mortgage loan subject to paragraph C of this section after application, the disclosure shall be delivered or placed in the mail not later than the third business day after the creditor determines that the loan is a higher price mortgage loan subject to paragraph C of this section. Number 6, copy of appraisals in general, except as provided in paragraph C2 of this section. A creditor shall provide to the consumer a copy of any written appraisal performed in connection with a higher price mortgage loan pursuant to paragraphs C3 and C4 of this section. Right, but the timing of the disclosure, let me just read that again because I just flew through that. 3 days after receiving an application for a higher price mortgage loan, we have to make that required disclosure under Reg B. The timing of the copy of the appraisal is no later than 3 days prior to consummation of the loan, or in the case of a loan that is not consummated, no later than 30 days after the creditor determines that the loan will not be consummated. The form of the copy. Any copy of a written appraisal required by paragraph C6(1) of this section may be provided to the applicant in electronic form subject to the consent and other provisions of e-sign. Roman numeral 6, no charge for a copy of the appraisal. A creditor shall not charge a consumer for a copy of written appraisal required to be provided to the consumer pursuant to paragraph C6(1) of this section. And 7, relation to other rules. The rules in this paragraph were adopted jointly by Federal Reserve Board, the OCC, the FDIC, the NCUA, the Federal Housing Finance Agency, and the Bureau. These rules are substantively identical to the board's and the OCC's higher price mortgage loan appraisal rules published separately. And evasion of open-end credit in connection with credit secured by a consumer's principal dwelling that does not meet the definition of open-end credit in 10.26(2)(a)(20). A creditor shall not structure a home secured loan as an open-end plan to evade the requirements of this section. Next section, 10.26.36. I'm going to record after taking a short break.